I'm Tom Murkowski. I'm a licensed life insurance agent in the state of Florida, and the purpose of this video series is to explain to you how you can use the cash value of your life insurance policy to invest in real estate. So in the previous video I explained how the different types of life insurance, and in this video I want to specifically talk about the equity indexed universal life insurance and why it's the best vehicle to invest in real estate. So equity indexed universal life, it's exactly like it sounds. The returns, the interest that you get credited to your cash value is equal to the return on a stock market index. It could be the S&P 500, the Hang Seng, the Nikkei. The only limitations are there's usually a cap, and currently it's 13%. It's set by the different insurance companies, and a floor of 0. So if the stock market goes up 5%, you're going to get 5% credit to your account. If the market goes up 20%, you're going to get 13% credit to your account. But like in 2000, 2008, when the stock market drops 40%, you're going to get a floor of 0. So in those cases, while you may not be taking advantage of the higher gains in the market, you're going to be outperforming the market by 35-40%, as in the case in the 2000s when the market crashed. So when the market comes back, you remember, if you had $100,000 invested in the market in 2000, that dropped down to about $65,000 by 2002, 2003 when the market was at a bottom. So when the market goes back up 10% on $100,000 is $10,000. 10% on $6,500 is $6,500. So you can see how as the market recovers, you're doing much better because you never lost principal. So you're probably wondering yourself, how can the insurance company do this? So I just want to take a second and kind of explain it to you. Insurance companies are masters of investing. They invest in safe, secure mortgages, investments, bonds, corporate bonds, and with that interest, they simply buy options on the stock market index. So they can lock in a gain if the market rises, say 13%. So as the market rises, the value of that option rises, and they can exercise it to lock in the gains. Conversely, if the market falls, the option becomes worthless and they simply let it expire. So that means that you don't lose any principal. So historically, equity indexed universal life insurance policies have generated about 8%, a little bit better than that, going back into the 1980s. But the thing to keep in mind is it's safe and secure. You're not taking part in the Wall Street roller coaster of 20-some% gains and 40% losses. So I hope this video has kind of explained how an equity indexed universal life insurance policy works. And in the next video, I want to talk about how we're going to design a policy to make sure that you have the maximum amount of cash value and liquidity so that you have access to it right away. So thank you, and here's to you making money with your money. Thanks.